Well, so far this week, investors are catching a better glimpse into the consumer as retailers such as Home Depot, Target and TJX release their latest financial results. Now, given what we've heard thus far, the retail landscape is seeing a bit of a shift on consumer behavior, making for a murky outlook for retailers. Home Depot started off the retail-focused week with a dreary outlook as it slashed its guidance for the full fiscal year, now seeing sales falling 2 to 5%. Meanwhile, retail giant Target also providing lackluster guidance as its second quarter outlook came in below analyst expectations amid a more cautious consumer. And TJX also providing a modest outlook on comparable sales coming in below estimates as well. However, seeing a bit of a bright spot for the full year in regards to adjusted earnings per share, the retailer raising its guidance, now expecting earnings between $3.39 to $3.48. And while retailers are proceeding with caution amid the changing retail landscape, our next guest says this is the year that TJX will set itself apart from its off-price peers. Here to break this all down and more is BMO Managing Director Simeon Siegel. Thank you so much for joining us this morning. So as we take a look here, you have an outperform rating on TJX. So when you look at some of the value plays in this space, why does this one stand out for you?
Hey, Rachelle, good to see you. So I think what you just went through is fascinating. And I think what's important is to distinguish expectations versus actual growth rates. These are very large businesses that are still growing. So even on that revenue side, you're still seeing that lift. It's not just EPS. And I think that's important to keep in mind. Now, to your point, why this company? TJ is actually a very important and probably underappreciated role within the retail ecosystem. We all know it as the place where we can get deals. But perhaps more importantly, I think the brands know it as a place that they can move a lot of goods and they can do it somewhat invisibly. I like to think that off-price wins because they don't have e-commerce, not in spite of it.
And it's interesting because usually it's the value plays that tend to do well. So when you hear on the call the sort of muted consumer expectations for full year 2024, what should we read into that? And what can TJX do to better position itself?
Sure. And so what's really interesting about TJ is we do perceive it to be value because it offers value. But at the end of the day, you're not getting cheap clothing. You're getting expensive clothing cheap. And so this is a company that's optimizing around value, to use your word, rather than optimizing around price. Other off-pricers there are certain companies that have goals to simply sell things that are $1, things that are $5, things that are $10, and they're very maniacally focused on ensuring that they have a low price. TJ, their entire essence, their identity is to make sure they have a good value. And so that ticket can actually be higher, which actually helps a lot with the trade down that you're referring to. So as people have to pull back their belt or tighten their belt, they're able to then go into TJX and find similar brands at better deals if they're willing to treasure hunt for them. But it also promises this notion of you're not just getting something that's cheap. You are actually getting that brand. So it carries this dual benefit. And I think that's why they're so important for the brands. I think the largest brands in the world can give product to TJX knowing that I can't go and search for it online. That makes it less brand dilutive while still allowing them to sell a lot of units.
And under that umbrella of TJX, it includes TJ Maxx, Marshalls, Home Goods, and some of these other off-price or valued plays as well. But Home Goods are dragged this earnings season. We did get a sort of a hint that might be the case when Home Depot reported. What do you think is going on in that space?
So I think we all bought a lot of furniture. We all bought a lot of patio furniture. We bought a lot of grills. I think we're still dealing with this consumer over purchase through COVID, where certain categories still need to work their way through the replenishment cycle. I don't think home goods is a bad business. I think it's an excellent business. I don't think home as a category is a bad category. I think it's an excellent category, but I think it's a longer replenishment cycle. And I think if we think about everything that we bought over the last several years, and you think about the fact that that couch is still sitting there, it's going to take time before we do that. So I think that it makes sense that the business is still underperforming, let's say Marmaxx, which is doing really well. But I think an important point to keep in mind is home goods was also the largest margin compressor for this company in the last several years. If you think about everything you and I have been talking about, everything we've heard about in terms of ocean freight containers getting more and more expensive, that hurts someone selling a couch a lot more than it hurts someone selling a sweater. And so I think what was important is we are seeing this margin stabilization. We're actually seeing home goods margin improve. And so there's this interesting dynamic where if home goods improves the top line, if the revenues actually come back this year, that's fantastic. If they don't, as long as the business is stabilized, they're a lower margin business that's weighing on the total less. As home goods becomes a lesser percentage of TJ's total revenues, it actually hurts the margin less. Now, obviously, from a profit dollar perspective, that's a different conversation. But as investors look at the EBIT rate, as they look at the margin opportunity, I think it's an interesting sort of a win-win, whether home goods does well or whether it still just stabilizes where it is.
And we know that you cover a wide range across retail. You've got Traeger. I mean, you've also got Burlington. I'm sorry, you get Burlington, Ross, Nordstrom, Lululemon, Ralph Lauren. So as you look at the spectrum here, especially when we look at the performance of Traeger, who would you say are really the biggest winners and losers when you have this sort of retail environment where you see consumer sentiment falling, retail sales not coming in as expected? Who are going to be the standouts here?
So I think TJ will. I think this is a special year for TJ. I think this is real. This is the year where we figure out and realize that they're not just a place that people send their mistakes. They're also a place that people consider as a core part of their full distribution model. But listen, you brought up Traeger. This is another example of a company that likely had an over purchase pattern by consumers that we need to work through. I think it's an excellent brand, but I think it makes sense that we're getting this recalibration. The common denominator when I think about them is which are the items that have fast replenishment. If you have a long replenishment cycle, doesn't mean your business is in trouble. It just means you need to take the time and focus on maintaining that brand equity. But at the end of the day, if you have a fast replenishment, then that's where we're seeing the greatest inflation or we'll call it the least need to promote. And so that's how we're looking at things broadly speaking. The faster your replenishment, the better the pricing power. The longer your replenishment, the worse. I think TJ wins in this current environment and starts to stand out from the way we normally think about off price as a clearance vehicle to really appreciating the fact that it's a core destination for these brands.
And something else that I wanted to bring up is shrink, some of this inventory loss, not from sales. We saw that come up for Target. Are you seeing it perhaps as drastically, though, in some of the brands that you cover?
Yeah, so TJ called it out last quarter, and it was a pretty material loss. The unfortunate answer is yes. I think figuring out order of magnitude and where it hits worst and who has already told us about it versus not. But shrink is absolutely something that unfortunately I think we all have to account for and consider and hopefully can be fixed.
Well, I do thank you for joining us this morning. BMO Managing Director Simeon Siegel. Thank you so much.